Steve Leisman is here.
Thank you. Thank you.
Our senior economics reporter.
For all of the time I've been an economics reporter, I have puzzled over whether or not in times of trouble, good economic results for McDonald's, good earnings for McDonald's are a good sign or a bad sign. Are people trading up or are they trading down to McDonald's? That's what I don't know. And I've never been able to come to a conclusion on that.
Let me give you some more information.
Color?
Yeah. U.S. traffic for McDonald's remained uneven during the first quarter. I think we forgot about the weather. So let's talk a little bit about that. Same-store sales visits fell 1.3% in January because of those winter storms. Traffic rebounded 3.8% in February on pent-up demand, they say. But it slipped in March to 1.2% in a more muted response to these new menu launches that were out there. Now, they're attributing that to rising. This is not McDonald's. This is this company watching some of it. It says it's rising fuel prices, hurting household budgets. But you're right. Like you and I have talked about this for a long time. Is this consumers trading down because they need to get some of these bargains? Or is this consumers saying, hey, I'm feeling a little more flush, so I'm going to go to McDonald's another time?
Well, then there's when you get to be my age. McDonald's is a luxury. I do it like once a month, maybe once every 2 months. So even though I know I shouldn't.
You and Warren Buffett.
Exactly.
Your luxury item.
Exactly. It's a luxury item.
All right. Steve is actually here because there is some new data that shows the gap between the earnings of higher and lower income groups is widening. That is more K-shaped in the K-shaped economy. Higher highs, lower lows.
This data is amazing. I'll explain why at the end, but let me just tell you what it says first. Two studies we have looking at income disparities, one on wages, the other on gas spending, show this widening gap between Americans with the highest and lowest incomes. The Bank of America Institute finding wealthiest Americans enjoying much bigger wage gains than middle and lower income families on a consistent and widening basis. That is, I wouldn't be here if this wasn't a trend that's been going on now for months. The report comes from actual bank account data. It found wage gains of 6% year on year for the highest income groups, 1.5% for the lowest. B of A economist David Michael Tinsley, he doesn't know why this is happening. He could be related to bigger bonuses that are out there. Automation, he said, could be undercutting the bargaining power of workers at the bottom end of the wage spectrum. Now, I didn't really believe this data, so I asked ADP to run their numbers. They also found a more steady but still rising wage gap between the highest and lowest paid workers. Highest paid workers on average are making 6.4 times what the lowest paid workers are bringing in, up from 5.9 in 2023. On the spending side, as you might imagine, the surge in gas prices hitting the poorest Americans the hardest. New data from the New York Fed finding that the wealthiest household, they boosted their spending, but they matched the increase in prices, so they kept their gas consumption the same. That's the orange line on the top. But look at what happened to the lower income families. They cut back on their gas consumption to make ends meet, and apparently maybe cutting back on McDonald's. They were hit harder in March than they were from the 2022 Russian invasion of Ukraine. Okay, overall, we know this from data last week. Real incomes adjusted for inflation, they've turned negative the past 2 months, and in 4 of the last 6 months, inflation has taken a bigger bite from paychecks right now. Retail companies reporting widely disparate takes on the consumers. We have Disney, Starbucks, Hershey's, and GM, who I found. They say the consumer looks great, healthy. Whirlpool saying today in its earnings release, the war in Iran leading to recession-level declines in U.S. appliance sales.
I'm glad you brought up Whirlpool.
Go
because
figure.
I have not been able to, I haven't looked through Whirlpool deeply enough. But for them to see recession levels when all of these other companies, you hear from Amex talking about how people are eating out more. Their reservations on planes and in restaurants are soaring. The company's making a ton of money. Now, Amex has a higher income spender, so maybe that reflects some of it. Why did you say you didn't believe this data when you first saw it?
Well, first of all, I just want you to know the world we're in now, which for me, this is what gets me excited about it. I am looking at aggregate banking data from Bank of America. That just blows my mind in the first place. Yeah. And then I'm looking at the New York Fed, which the Fed does things so slowly they make molasses look like a rabbit, okay? To mix a couple metaphors right there. But here's the thing. They went and they looked at a panel of 200,000 spenders from a company that was giving them credit card spending data. And it's May, and I'm looking at March spending data. That just blows my mind. Sorry, little footnote there. But if you guys wouldn't mind calling up the first chart again, with all of this new big data, I want to be very cautious. I don't want to come out and go, but then you look at the data on the first chart, and it's persistent. It's persistent, and it's widening. That orange line, it's going up, and it's going up for a while. We don't know why. It could be some effect of the tax breaks. from the Trump administration.
Well, I was going to bring up tax breaks. So this comes in at the beginning of the year.
The other thing that makes me feel good about the data is this is a year over year. You see 3-month percentage change year over year. So it's not picking up a spike in a single month. It's easing it out. And you can see that it's widening there over time.
Okay, I have liked the Bank of America data because it tracks so many, both consumers and business accounts that they have across the board. I mean, I've just thought that they've got more data than a lot of the federal government.
And what they're doing is just like, okay, you got a customer who had a wage deposit. They can see what that wage was this year, and they can look at it from last year, and they average it over 3 months. So, look. If you look at the chart, we are getting wage gains for low and middle Americans. That's good. It's not bad that wealthy people are making more. The question becomes why. The question becomes, I mean, this could be, if it was just bonuses, it would show up quickly and it would go away, but it hasn't gone away. So it's something worth watching. And obviously, we talk about this, among other reasons, for you had Paul Hickey on in the 6 o'clock hour says, get into consumer discretionary. Right. I don't know. Maybe that's right. But right now, we're still seeing the effects, and I'm as excited and concerned to see the April data, because March was just the onset of it. And what we know is that what consumers do, and you know this, Becky, you'll paper it over for a while. Right. We did see a decline in the savings rate to a 3.5-year low. We are seeing an increase in credit card data or credit card usage. So you might use a little bit of debt. After a little bit of time, you make an adjustment that's more permanent.